Hello, and you're welcome to Global Business Insights, where we go a little deeper into the business headlines from all over the world. The G7, that's group of 7 members, have agreed a 50 billion loan package to Ukraine to be funded by profits from seized Russian assets. The Bank of Japan board members, after a 2-day monetary policy review meeting, have decided to maintain the key interest rate at 0%. And in the US, markets are ending the week on a high note, helped by Factorygate, that's PPI inflation data, which came lower than expected. The Nasdaq closed up 0.34%, and the S&P 500 also up 0.23%. Both Nasdaq and S&P 500 are marking a fourth straight closing record. The Dow slipped, however, 0.17%. Europe's auto industry had warned of exposure to retaliation from China after imposing as much as 38.1% tariffs on Chinese electric vehicles. German car makers are the most exposed to any counter moves, as almost a third of their sales came from China last year. Donald Trump floated the idea of using tariff hikes to fund income tax cuts, injecting more uncertainty into global trade and consumer prices. Tesla shareholders have given the nod to CEO Elon Musk's humongous $56 billion compensation package and moving the company's state of incorporation to Texas, confirming confidence in his leadership. NNPC Limited, Nigeria's state oil company, has withdrawn its case to stop an ExxonMobil core sale of its oil and gas assets to SEPLAT Energy PLC, paving way for conclusion of the deal. Many are of the view that the US economy is showing mixed signs, with preliminary evidence indicating softening inflation and a resilient labor market with pockets of weakness. May producer price index rose 2.2% on a yearly basis. That was data that came in yesterday, below 2.5% expected, and annual core PPI also rose by 2.3%, also under expectations. But weekly jobless claims showed 242,000 claims in the week ending June 8, higher than initial estimates of 225,000 and last week's print of 229,000, pointing to expanding weakness in the labor market. Later today, we get June Michigan Consumer Sentiment Index, which could shed more clues. The Federal Reserve projects fewer cuts as it awaits clearer direction from the data. And if you look at the mixed signs on the economy, inflation and labor markets, all these are delaying the Fed in gaining the confidence they need to begin easing with rate cuts, thus lagging behind Europe in bringing down costs for borrowers. Stock markets are flirting with record highs, but that is pointing, I think, to a deceptive resilience distorted by an optimistic artificial intelligence narrative rather than a broader recovery. The small cap Russell 2000 has barely inched up this year compared to the Nasdaq, which is up over 18%. Also in the US, the S&P Global US Composite PMI rose to 54.5 in May 2024, up sharply from 51.3 in April and above a preliminary estimate of 54.4. The message the Fed and the FOMC are getting is that the economy can bear to have rates higher for longer. If this comes out as yet another wrong conclusion, similar to a previous wrong narrative that inflation last year was going to be transitory, then the results in quarter 3 and quarter 4 will be much weaker growth in the broader economy, weighed by higher interest rates. A slump in consumption and retail appetite and tight purses will also eventually hurt demand and capacity to pay the huge upfront bill for new artificial intelligence technology assimilation, thus compressing margins for AI players. Add to that the geopolitical uncertainty, as we could get political swings and geoeconomic conflicts manifesting in fresh shocks. My conclusion is that this rally we are seeing in US stock markets cannot be trusted, and the wiser trader has a diversified portfolio prepared for any shock, albeit at the cost of today's profits. Europe did its best this week not to be as hard as the US in slamming high tariffs on Chinese EVs, a move that European car makers are warning will attract retaliation from China. China accounts for about a third of unit sales of European vehicle giants, and though under 1 in 5 of the company's cars sold there is imported from Germany, these are the high margin top end models. As China raises tariffs and finds ways to curb European car imports, European manufacturers targeting Chinese markets may move into China, hoping that in-country production will be better received. Also, if China EVs are made more expensive in US and Europe, China will target Asia, Latin America, and Africa more aggressively, requiring these regions to be alert to dumping and even perhaps protect their economies. Higher cost of EVs worldwide as a result will also reduce the demand for EVs and slow the clean energy transition. I suspect there could be opportunities as the world seeks alternatives to China, making Vietnam, India, and Africa potential spots as they position themselves with incentives for players. Africa needs to take advantage of the situation by advancing policies that compel manufacturers who want to sell in its market to set up plants in the continent as it de-risks the environment. Tepid growth in Europe has become a bigger political issue as opposition parties blame leaders. It is still unclear if the political transition in France and Germany will result in an alignment with the US in its anti-China positioning, or a more populist situation where the new parties of the new government are motivated more by economic considerations. It could be that many of these tariffs may be relaxed, especially as China toughens on the retaliation front. A lot will also depend on what happens in the White House in November. However that plays out, a Cold War with China is set to get colder. Like Germany and Britain before World War I, China and the United States seem to be tied together in a downward tango, which may end in disaster for both countries and for the world at large. Similar to the situation a century ago, where we saw economic competition, geopolitical fears, and deep mistrust fueling an antagonism that led to wider global conflict. Businesses, I expect, should be positioning with more caution given how all this is evolving. Ghana has presented a new debt restructuring proposal to international bondholders as they seek to rework $13 billion of euro bonds, definitely too burdensome for them to service. The fiscal stress and challenge of high foreign debts as interest rates in the US stay higher for longer are issues for African economies like Ghana. The more prudent will be boldly and radically plugging leakages linked to weak control processes, fueling corruption, and slashing cost of governance to create the vastly diminished fiscal space to invest in people and vital infrastructure. But that may still not be enough. Renegotiation to reduce costs of servicing bonds, as we see in Ghana, is inevitable as debt service becomes way too high, leaving very little to run the country, talk less of investing. Foreign creditors expect payment, prodded by sharp financial advisors motivated by high fees, milking environments where poverty is increasing. Ghana is definitely not the only African economy in the basket of debt-shackled countries hoping to escape debt captivity, as analysts see many trapped in an unsustainable debt scenario. And in Nigeria, the national oil company NNPC Limited has withdrawn its legal challenge to ExxonMobil sale of its oil and gas assets to SEPLAT Energy. Industry leaders have been pointing out the poor handling of the divestment of IUCs to local players, which has led to extended periods of no investment and blocks left fallow. The present industry structure, with many outdated agreements and constructs struck decades ago, is holding back progress. New executive orders have tried to improve the environment for operators, but a more fundamental rethink that can position the nation to attract investment into the entire value chain is required, and not just in the upstream sector, where investment from production of late has taken a plunge as inefficient and suboptimal structures and processes continue to make things difficult. Asia-Pacific markets were mixed after the Bank of Japan kept its benchmark interest rate unchanged. The Bank of Japan board members, after a 2-day monetary policy review meeting, maintained the key interest rate at 0% after hiking for the first time since 2007 in the March meeting. The BOJ said it would also begin scaling back its 6 trillion yen, that's $38 billion monthly bond buying program, which is a critical milestone in unwinding its ultra-loose monetary policy. The bank also said uncertainties surrounding economic financial developments remain high, adding that Japan's economy has recovered moderately, although some weaknesses linger. Inflation expectations have also risen moderately. Japan's Nikkei 225 reversed losses to close up 0.24% after the Bank of Japan decision. Other shares in the Asian region are looking mixed. Hang Seng, that's the Hong Kong index, down 0.65%. Shanghai Composite also closed down 0.06%, while the Shenzhen was up 0.37%. The South Korean Kospi also up 0.26%. Well, that's it from me on Global Business Insights. This is Bode Oshosami. Thanks for sharing and following or subscribing on YouTube, Facebook, LinkedIn, and X. Please send your comments. Thank you very much for watching. Bye-bye.